Hello and a very warm welcome back to the Deep Dive. This is your essential shortcut to, well, being really well informed. We take a pretty complicated stack of source material, articles, research, you name it, and we break it all down into the most critical insights you really need to know.
Yeah.
We're so glad you're here with us, ready to really get into some serious conversation today.
Yeah, great to be here. And today we're tackling something pretty profound, actually. A really fast-moving shift in the world of finance. Specifically, how entrepreneurs are making, or maybe sometimes how they're avoiding, those tough decisions in, well, the landscape of 2025. Artificial intelligence has given us these tools that offer incredible clarity, speed, confidence.
But that speed, that clarity, as amazing as they feel, they raise a really difficult question, don't they? Is the very tool that's designed to give us this definitive edge AI, is it actually making founders, financial decision makers, dangerously blind? Blind to the natural, sometimes messy world of business risk. Our deep dive today is titled AI Overconfidence. Is tech making entrepreneurs blind to risks in 2025?
And this is such a critical angle because, look, this isn't just about the code or the computational power itself. It's really about human psychology. It taps into our timeless biases, our inherent, desire for validation, our love of the easy answer. And now all of that is just supercharged by this technology, that feeling of algorithmic certainty. It's possibly the most seductive force in finance right now.
Okay, so let's really unpack this then. We're exploring what happens when we start outsourcing our critical thinking, our judgment, to what feels like a black box. What's the real cost of that perceived certainty? And maybe more importantly, how can we use these incredibly powerful tools without losing our fundamental ability to evaluate genuine risk? We've got some deep research here connecting, massive market failures right back to specific cognitive errors. Let's maybe start by just setting the scene, nailing down the financial velocity of 2025.
Yeah, to really get the psychological trap, we first have to ground ourselves in the financial reality of this moment. Because we are in an investment boom that's so intense, it almost warps the perception of success for anyone involved.
Massive feels like the right word. Just look at the capital pouring in. Venture capital investment in AI has just soared, creating this profound tilt in the market. Reports are indicating that roughly, 40% of all investment raised by funds last year came from those specifically listing AI as a focus. It's not a niche anymore.
Oh, absolutely not. It's the center of gravity for global finance right now. And the dollar figures we're talking about are just staggering. Over $44 billion poured into AI startups and enterprise tools. And that was just in the first half of 2025. You talk to analysts, and they're predicting AI could contribute over, get this, $6 trillion to the global economy by 2030. The market signal couldn't be clearer. AI is the future, and money has to flow to it, like now.
And if you're an entrepreneur listening right now, that sheer volume of cash, it kind of gives you a psychological shield, doesn't it? If everyone is investing, if every major fund is scrambling to put AI in their mandate, you feel inherently validated. You might feel like you can't possibly fail because you're riding the definitive market trend.
But, and this is a big but, here's where the warning signs start flashing bright red. Because despite this unprecedented flood of capital, it's actually led to the rise of something we really need to pay attention to.
Yeah.
These so-called zombie corns.
Zombie corns. Okay, the name itself is pretty chilling. It suggests something that's, walking around but should probably already be dead.
Precisely. Tom Glasson over at ScaleWise, he's an investment strategist. He really highlighted this harsh truth about the generative AI sector.
Yeah.
He describes this pervasive wave of overfunded startups that look healthy on the surface, but are commercially hollow underneath.
Right. So they've got maybe 9 figures in the bank account, beautiful, polished presentation decks, but there's no actual engine there for long-term survival.
Exactly that. These zombie corns, they raise enormous rounds, Series B, Series C, all based on future promise and this, algorithmic confidence. But they consistently fail to build sustainable revenue streams or viable unit economics. Glasson argues, and I think he's spot on, that founders are fundamentally confusing capital raised with genuine traction. The psychological mechanism here is pretty simple, really. The fundraising process itself becomes the validation. It replaces the hard, gritty work of actually building a resilient business model.
But why does that mismatch persist? I mean, if the underlying numbers are often so bad, shouldn't the VCs, the private equity firms, shouldn't they slow down? It almost suggests that the investors themselves might be suffering from this same kind of automation bias you mentioned earlier.
Yeah.
Like they're afraid of missing out on the next big thing.
That's a great point.
And they're relying on the overall market buzz, that collective algorithmic hum, instead of, fundamental due diligence.
I think that's a key connection, absolutely. That collective FOMO fear of missing out, it fuels the continued flow of cash, and that allows these zombie corns to just keep going. They stay afloat because they can continuously raise more capital based on their AI story, their promise of exponential scale, and it effectively masks the fact that they haven't actually solved a truly commercially viable problem yet.
And this leads us directly to that core data point that really shocked us when we were looking into this. It reflects that fundamental mismatch between the hype and the reality on the ground. You'd think with $44 billion going in, the success rate would be extraordinary. You'd expect wins everywhere. But a recent MIT study, it's called the Gen AI Divide, State of AI in Business 2025, revealed a pretty brutal reality. 95% of generative AI business projects are failing to deliver meaningful results.
95%. Just let that number sink in for a moment. Only a tiny, tiny 5% sliver is actually achieving, real revenue acceleration or measurable productivity gains. This means that the immense financial hype we see everywhere is just colliding head-on with systemic project failure. The failure rate, it's kind of reminiscent of the early internet booms, right? But the capital involved this time around is just exponentially large.
So why? Why such a catastrophic failure rate, even with presumably the best talent and all that funding?
Yeah.
What are companies fundamentally getting wrong here?
Well, the MIT study really pinned the leading cause on what they called a learning gap. Essentially, companies, especially the big enterprises, they rush to deploy these generic off-the-shelf large language models, the kind, anyone can access relatively easily now.
Yeah.
But they failed. They failed to properly adapt those generic models to their own niche, complex internal requirements.
It sounds like they tried to use a kind of one-size-fits-all hammer to fix every single specialized problem across their entire business, and that leads to what you call fragmentation.
Exactly. Fragmentation. Look, generative AI is fantastic for generalized tasks, writing emails, summarizing documents, basic coding. But when you try to apply it to proprietary company data or specialized internal workflows or really niche compliance standards, those generic models often just break down. So companies end up spreading their investment way too thinly across maybe dozens of these generalized projects. The result is fragmentation and eventually project collapse before they can achieve any meaningful scale. They just fail to master that crucial last mile of application.
And the contrasting evidence really reinforces this point, doesn't it? Which is maybe what we need to focus on for solutions later.
Absolutely. The researchers found that, interestingly, smaller startups, often leaner, more agile, they were thriving. Why? Because they did the exact opposite. They focused narrowly, laser-focused on solving a single acute business problem, maybe automating hyper-specific legal contract, drafting for one industry, or streamlining supply chain logistics in a very particular sector, like, say, rare earth metals.
They weren't trying to boil the ocean.
Precisely. They mastered the narrow application first, and this focus allowed them to achieve really rapid scale. We saw examples of companies going from zero to, say, $20 million in revenue in just 12 months. How? Because they tailored the AI to their proprietary data and those deeply specialized requirements. They succeeded by focusing on depth, while the Fortune 500 giants, with their sprawling, thin investments, ended up with these fragmented 95% failure rates. The lesson seems pretty clear. Success relies on domain mastery, not just algorithmic generality.
But the noise in the market, that $44 billion number, it's just so loud, isn't it? It completely drowns out the quiet, maybe uncomfortable reality of the 95% failure rate. And that immense financial narrative creates an environment where founders feel validated, maybe even feel inherently immune to that reality check and that illusion.
Well, that leads us directly into the cognitive traps that AI seems to exploit so masterfully. Yeah, that profound mismatch between the soaring investment and these massive failure rates. It exists because AI seems to exploit these core, deep-seated weaknesses in our human decision-making processes. And to really understand this, I think we need to analyze the qualitative shift between the financial tools of the past and what we have now.
Okay, let's start with the classic 20th century tool, the spreadsheet. Like Microsoft Excel. It was absolutely revolutionary for finance, for risk modeling, projections. But the key difference was transparency, wasn't it?
Totally. The spreadsheet was fundamentally a deterministic tool. You, the user, wrote the formulas. You could click on any output cell, trace the dependencies all the way back, audit the logic step by step. If the numbers looked off, you knew exactly where to start looking for the error in your own logic or data entry. It augmented human intelligence, definitely, made us faster, more precise. But the human always remained the master of the underlying logic.
Right. Now, fast forward to 2025. We've essentially traded that transparent spreadsheet for the black box. And that change It fundamentally alters our relationship with the output, doesn't it?
It's a massive qualitative shift. These generative AI models, they're based on deep learning networks, neural networks with literally billions of opaque parameters. We feed the system some input and we receive back this authoritative, polished, and often incredibly confident-sounding output. But the journey between the input and that final answer, it's largely a computational mystery. It's a nonlinear emergent process that, honestly, even the AI engineers themselves sometimes struggle to fully interpret or explain.
So we're essentially forced to treat the AI like our modern Oracle of Delphi.
Yeah.
It provides an answer that feels incredibly wise, very authoritative, but it's a wisdom we have to take almost entirely on faith, because we can't realistically interrogate its internal reasoning the way we could trace back a simple SUM formula in Excel. And that inability to audit the logic, that's where these cognitive biases just flood in, isn't it? Eroding our critical faculty.
Yeah, absolutely. And the first and arguably most dangerous bias here is automation bias. This is that deep, innate human tendency to heavily favor suggestions coming from automated decision-making systems. And crucially, we tend to ignore or discount contradictory information, even if that contradictory information is demonstrably correct.
Like a trust reflex, basically.
Yeah.
You're faced with a really complex problem, the machine spits out a clear, confident answer,
Yeah.
and our brain just defaults to the path of least resistance. It becomes far too tempting to just outsource that healthy paranoia, that skepticism that's absolutely required for high-stakes risk assessment.
Yeah, one of our sources put it perfectly, I thought. AI is potentially the most convincing excuse for laziness we've ever invented. And this intellectual laziness, which is supported by the seemingly authoritative AI output, leads to these twin dangers. First, you get commission errors. That's where users follow bad automated advice, actively ignoring other, maybe more accurate data points that contradict the machine. And second, you get omission errors. That's where the AI fails to detect a problem, maybe a subtle risk, and the human user also fails to notice that failure because they've stopped actively monitoring the system. They've handed over vigilance to the machine.
Okay, let's make that danger really concrete. Think about, say, automated systems in aviation. When the autopilot provides a clear flight path, the pilot's brain naturally focuses a bit less on scanning all the peripheral data, right? So if the automation system then malfunctions slightly, maybe misreads an altitude sensor, the pilot might commit an omission error. They fail to notice a critical change because their brain was implicitly relying on the machine to handle that baseline monitoring.
Now, just apply that exact same logic to finance. When the AI model tells an entrepreneur, hey, your projected cash flow is secure for the next 18 months, that entrepreneur is suddenly highly likely to ignore some small, maybe uncomfortable data point about, say, rising political instability in a key supplier region. The brain just opts for the easy, confident answer provided by the machine and effectively outsources the necessary, if uncomfortable, paranoia.
And then you layer onto that the Dunning-Kruger effect on steroids. We know the classic effect, right?
Yeah.
Novices tend to overestimate their confidence because they simply don't know enough to realize how much they don't know.
Yeah.
How does AI turbocharge this?
Well, it creates this powerful illusion of expertise. Think about it. An entrepreneur, maybe relatively inexperienced, can now prompt an AI tool and instantly generate expert-level financial forecasts. They get sophisticated market segmentation analyses, polished competitive landscapes, work that honestly used to take entire teams weeks or months to compile. And the output looks clean, it's articulate, it's highly professional.
So the AI provides the polished report, the confident number, but the user lacks the underlying substance, the why behind it.
Precisely. They get the feeling of expertise without the hard-won competence. They lack the scar tissue, that intuitive, almost visceral understanding gained from past failures, past near misses, that tells a seasoned expert, hang on, this projection looks a little too perfect. There must be a flaw, something we're missing here. The AI inflates the user's confidence far, far beyond their actual contextual knowledge or experience. It leaves them dangerously unaware of the subtle nuances, the unquantifiable risks, the unknown unknowns that the model, by its very nature, simply cannot see or factor in.
And what's really fascinating here, pulling from the research, is that this overconfidence isn't just some unfortunate byproduct. It seems to be an actual driver of adopting this technology in the finance space.
Yeah, there was a study analyzing the adoption of novel algorithmic technology, specifically looking at robo-advice platforms in personal finance, and it found a really clear link. Investors who scored higher on measures of overconfidence had a significantly higher propensity for adopting these automated systems.
Wow. So the people most likely to embrace this kind of opaque technology are the ones who already feel maybe a bit too confident in their own knowledge and judgment to begin with.
It seems to create this kind of self-selecting, potentially high-risk user base early on. The study suggested the adoption wasn't primarily driven by, say, risk aversion, but rather by an unjustified confidence in one's own knowledge and often a strong divergence of opinion, basically thinking they know better than the market average, especially in uncertain market conditions. And the findings were pretty compelling. Excessive confidence in one's knowledge consistently outperformed a person's general willingness to take financial risk when predicting who would adopt robo-advice first. These early adopters weren't adopting the tool because they felt cautious. They were adopting it because they expected higher, faster returns from this new innovation, which just further confirmed their existing certainty bias.
Okay, so let's recap that psychological mix. We've got the black box, which is basically impossible to fully audit. It's feeding an output that feels authoritative and often validates the user's pre-existing overconfidence, which in turn encourages a kind of intellectual laziness or outsourcing of vigilance.
It really is, as you said earlier, a recipe for potentially spectacularly costly failures when that confidence bubble bursts.
Right. So let's move now from the theory, the cognitive biases, to the concrete consequences. What happens when that illusion of certainty hits the messy, unpredictable reality of global commerce? We can illustrate this pretty well with the story. Let's call her Maya, an entrepreneur who secured funding based almost entirely on her algorithmic conviction.
Okay, tell us about Maya and Archimedes, her innovative logistics platform. What happened there?
So Maya needed to raise a Series A round for her innovative logistics platform. Pretty standard startup scenario. Her pitch presentation was flawless, really polished, powered by this AI tool she'd affectionately named Archimedes. When presenting her financial projections, Archimedes generated this glowing chart showing an 87% probability of achieving profitability within 24 months. Now think about that number, 87%. That's a kind of confident, quantitative, almost irresistible answer that investors crave, especially in the high-risk startup world.
Yeah, 87% sounds like practically a guarantee in that context. Hard to argue with. Exactly. And when a skeptical investor pushed back, challenged her on potential supply chain cost increases, she didn't hesitate. She confidently quoted another AI-generated forecast from Archimedes. Costs would stabilize and actually decrease by 8% in the next fiscal year based on historical shipping efficiencies and trends. She got the funding. But the crucial point is she got it based not on her own deep contingency planning or maybe gut feeling, but on the machine's seemingly unshakable conviction. And the irony is that moment of fundraising triumph, that was also the precise moment she effectively outsourced her healthy, necessary paranoia.
Okay, so what did the AI miss? Because as we know, these models are only as good as the data they were trained on, right? They don't have a crystal ball.
The failure was really twofold. First, that confident 8% cost decrease projection. It was based entirely on a decade of relatively stable historical logistics data. Smooth sailing, basically. Archimedes couldn't possibly predict a sudden, massive geopolitical flare-up, let's say, hypothetical tensions escalating rapidly in the South China Sea in late 2025. This kind of event severely disrupted global shipping routes for a key raw material her platform relied upon. It was a classic black swan event, totally outside the historical pattern that backward-looking modeling simply cannot account for.
She needed that human foresight, didn't she? The ability to ask, okay, the history looks good, but what happens if this stable history breaks? And then build in the contingency, the backup plan.
Precisely. And the second failure was more contextual, more nuanced. The AI's consumer adoption model, the one predicting that 87% profitability, was trained heavily on North American and European consumer behavior data. But Maya was expanding aggressively into a key Asian market, and the model completely failed to grasp the rapid, localized, almost viral traction of a competing indigenous technology that popped up unexpectedly in that specific region. Because she had relied so entirely on Archimedes' optimistic 87% number, because she'd outsourced her risk evaluation, Maya hadn't built in the necessary financial cushioning. She hadn't established alternative supply relationships just in case. She didn't have robust, localized product development feedback loops set up.
So her business, once seemingly guaranteed 87% success by the algorithm, now teeters on the brink of collapse. All because she accepted that algorithmic certainty instead of demanding human contingency planning. And this kind of over-reliance, unfortunately, it doesn't just hurt individual entrepreneurs like Maya. It potentially introduces a massive systemic risk into the financial markets as a whole. something the Financial Stability Board, the FSB, has been actively warning about.
That's right. The FSB, which is the international body responsible for monitoring the global financial system, is deeply concerned about what they call the AI herd effect. Think about it. If every investment professional, every major bank, every hedge fund starts relying on similar AI models, which often share common training data sources, similar foundational architectures from just a few big providers, what happens when they all simultaneously spot the same buy signal based on that shared algorithmic logic?
They all execute the same trades at the same time, create these huge, potentially destabilizing market correlations.
Exactly. And this introduces significant third-party concentration risk. If those common underlying models are opaque, if they remain these black boxes we talked about, and they all simultaneously generate the same sell signal during a market stress event, it could cause devastating, rapid, synchronized sell-offs, accelerating market volatility far beyond what human traders could possibly manage or absorb. The FSB warned specifically about AI's potential not just for correlation, but also to potentially spread disinformation rapidly in financial markets and to increase volatility due to opaque data quality issues, the widespread use of common models among key financial players.
That makes a lot of intuitive sense. You can't easily audit the model, so you have no real way of knowing if a subtle flaw in its logic is unique to your firm or if it's shared by the other 37 largest players in the market who are using a similar underlying engine.
Precisely. And this systemic risk gets magnified because the tools themselves, these large language models or LLMs, have fundamental limitations when dealing with the kind of deep, complex reasoning required for true strategic foresight. We really need to acknowledge the unquantifiable risk inherent in LLM limitations in critical thinking.
Yeah, what's fascinating here is trying to define where human intelligence still unequivocally wins out, even in 2025.
Well, the research suggests humans still win decisively when tasks require things like extended deliberation, genuine collaboration involving negotiation and compromise, accessing deep intuition based on experience, making complex ethical judgments, and especially strategic foresight that involves truly novel concepts or situations the AI hasn't seen before. It partly comes down to the verification mechanism in our brains. Our human intelligence uses this recursive thinking model. We have the fast, intuitive System 1 thinking, but we can consciously override it with the slower, more analytical, deliberate System 2 thinking. And crucially, we employ metacognitive monitoring.
Metacognition that's thinking about your own thinking,
Yes.
right? Knowing the limits of your knowledge, that seems key.
Absolutely. And the LLM, despite its incredible speed and fluency, struggles immensely with this. Research consistently shows LLMs demonstrate significant limitations in these metacognitive abilities. They struggle to reliably recognize their own knowledge gaps. They have difficulty managing genuine uncertainty, often presenting guesses as facts. And they struggle to reliably self-correct errors without substantial external human feedback loops. Think of it this way. An LLM can generate a highly plausible, confident-sounding piece of text very, very quickly. But it can't easily step back and ask itself, do I really know this? Or am I just generating statistically probable text based on the patterns in my training data?
That's so critical for an entrepreneur, isn't it?
Mm-hmm.
You need your tools or your own mind to be able to say, hey, I don't actually know the answer here because this is a genuinely novel situation,
Right.
rather than just receiving a confident but completely fabricated hallucination.
Exactly. LLMs generally have quite limited working memory compared to humans for complex multi-step reasoning, and their internal feedback loops for error correction are relatively shallow. Given enough time for deliberation, well-educated humans with domain expertise will almost always deliver superior solutions to complex, novel problems. Why? Because we can cycle through information repeatedly, refine our understanding, challenge our own assumptions, and ultimately recognize the boundaries of our own knowledge. That self-awareness is absolutely essential for high-stakes risk management. We need to actively defend the value of that slower, recursive, more critical human intelligence. Okay, so the good news, as we move into strategies here, is that the path forward isn't really about rejecting AI altogether. That ship has sailed. It's much more about building a structured decision-making process, a workflow that actively preserves and even sharpens human judgment, preventing the AI from becoming just a convenient cognitive crutch.
Right. So the ultimate antidote to this AI-fueled overconfidence, then, it has to be intellectual humility, doesn't it? We need to consciously shift the focus, sometimes, from just speed and efficiency back towards deliberation, defending the value of that slower, more careful, recursive human intelligence we just talked about.
Absolutely. Entrepreneurs, investors, leaders, they must ensure that AI outputs are rigorously scrutinized, constantly challenged through things like vigorous scenario analysis, what-if planning, and applying deep domain-specific judgment. The focus has to be on embedding AI within workflows that actually foster, maybe even amplify our cognitive engagement, not replace it entirely. Ideally, we should use the AI to help us identify potential flaws or biases in our own thinking, rather than just using it to validate our existing biases and preferred outcomes.
Okay, so practically speaking, how does an entrepreneur or leader actually achieve this kind of synthesis? It sounds good in theory, but how do you do it? It probably starts, like most good changes, right at the top.
Yeah, leadership by doing is absolutely paramount here. Leaders cannot simply rely on theoretical reports filtering up from their AI department or data science team. They need to gain direct, hands-on experience with these tools themselves. They need to experiment with them, run their own prompts, try to break them. They need to personally understand the capabilities, yes, but perhaps even more importantly, they must understand the failure modes, the limitations, through direct personal application. That direct experience builds the necessary, healthy skepticism required to ask the right, probing, critical questions of the outputs they receive.
I really love this next idea, which sounds like it's borrowed straight from cybersecurity protocols. Red team your AI.
This should be non-negotiable for any critical application, I think. You must actively, aggressively try to fool your AI systems. You need to approach the output almost as if it's actively trying to deceive you or hide something. Feed it deliberately flawed or incomplete data sets. Give it pessimistic, extreme case, or even internally conflicting prompts. Really try to discover where its core logical boundaries and its inevitable blind spots actually lie.
So if the AI confidently spits out, we have an 87% chance of success. The red team exercise is to immediately follow up with, okay, now model the success rate if our primary raw material costs unexpectedly increase by 40% due to a new trade tariff we didn't anticipate. You deliberately force the catastrophic scenario.
Exactly. You stress test the hidden assumptions that are inevitably built into the model's training data or architecture. Understanding those logical boundaries, knowing where the model breaks down or gives nonsensical answers, is just as important, maybe more important, than simply knowing its core capabilities. This proactive probing helps ensure you build the necessary cushioning, the alternative plans, the plan Bs that poor Maya failed to implement because she trusted the initial optimistic number too much.
And if we connect this back to the bigger picture, the goal isn't just finding the AI's flaws, it's about systematically infusing that crucial human contextual wisdom into the technology itself, right? That success case you mentioned, the agricultural tech startup down in Brazil, seems to perfectly illustrate this kind of synthesis.
Yeah, it's a great example. Their initial AI model, which was trained on generic, massive global weather patterns and crop yield data, provided these clean, highly generalized, and ultimately overly optimistic predictions for local crop yields in their specific region of Brazil. But the founders, crucially, had the intellectual humility to doubt the machine's generic answer.
They realized the model lacked the why, the local context.
It completely lacked the local context, the nuance. So instead of just blindly trusting the generic data output, the founders spent months, literally months, engaging in deep, qualitative research. They went out to talk to local, multi-generational farmers in the region. They gathered that invaluable ancestral knowledge about hyperlocal microclimates, specific soil conditions unique to certain valleys, historical pest patterns, weather anomalies, all these nuances that no standardized global data set could ever fully capture.
And they took that deep human wisdom, that slow, messy, context-rich knowledge, and they used it to actually retrain their AI model.
That's exactly what they did, and the result was spectacular. They built a model that was perhaps less naively optimistic on the surface, but was far, far more accurate and critically more practically useful for the farmers they were serving. They succeeded not by just accepting the generic AI output blindly, but by actively teaching the AI, by mastering that synthesis between the cold, global statistical logic and the warm, specific local wisdom. They essentially used the machine's speed and processing power to scale and operationalize their deep human insights. It's a beautiful example of partnership.
Ultimately, then, all of these strategies, the leadership involvement, the red teaming, the infusion of human wisdom, they all circle back to a fundamental requirement in the infrastructure itself: AI governance and trustworthiness. To genuinely reduce these negative risks we've been talking about, the AI systems themselves must meet certain established criteria, right?
They absolutely must. If we want to rely on these systems for critical decisions, they need to be designed from the ground up to be safe, secure, and resilient. They need to be, as much as possible, explainable and interpretable, moving away from the pure black box. They need to be demonstrably fair, avoiding harmful biases, and they must be accountable and transparent in their operation and outcomes. If companies neglect these crucial characteristics in the mad rush to deploy AI quickly, you exponentially increase both the probability and the potential magnitude of the negative consequences when things inevitably go wrong. We have to integrate human factors, things like human-centered design principles, constant test, evaluation, verification, and validation, TEVV, throughout the entire AI lifecycle, from conception to deployment to ongoing monitoring. This helps ensure that the technology ultimately serves human goals and values, not the other way around. We have to remain the wise partner in this human-AI synthesis. Hashtag conclusion and provocation.
So we began this deep dive asking that core question: is AI making entrepreneurs blind to risk in 2025? And what we've really uncovered, I think, is that the technology itself is essentially neutral. It's a tool. But it's a tool that seems to dangerously exploit our innate, very human cognitive flaws, our profound desire for certainty in an uncertain world, our tendency towards intellectual laziness when an easy answer is offered, and maybe even our deep hunger for external validation.
Yeah, the greatest risk here isn't necessarily that the AI itself is inherently flawed, although it often is. It's that the AI is dangerously good at confirming our pre-existing biases, at reinforcing our comfort zones, at telling us what we want to hear in a very convincing way. True financial health, true resilience in 2025 and beyond, it seems to be defined by that synthesis of human and machine. It's defined by the leader, the decision maker, who possesses the intellectual humility to know what the AI cannot possibly do, what it doesn't understand, and who has the courage to listen to that dissenting human voice, that nagging doubt, even when the algorithm is humming confidently along.
It feels like the ultimate antidote to the black box of the algorithm is actually the transparent, honest exploration of the black box within our own minds. Understanding our own biases and limitations, the greatest risk we face, maybe, whether we're running a Fortune 500 company or just managing our own personal finances, is inadvertently outsourcing our own judgment, our own critical thinking, our own healthy paranoia.
And this raises, I think, a really important, maybe even provocative question that will likely define the future of business and finance. The defining challenge going forward is probably not going to be about who is ultimately smarter, humans or AI. It's much more likely to be about whether we are wise enough to resist the powerful allure of speed and certainty when the stakes truly demand slow, deliberate, recursive, critical thought. Our economic survival, maybe even more than that, could depend on our ability to defend the value of taking time to think, taking time to question, and taking time to be constructively paranoid in the face of algorithmic confidence.
We really want to build a community here at the Deep Dive, a place where we can all learn from each other's journeys, our successes and our failures, as we all try to navigate this incredibly complex, technologically accelerated landscape with a bit more awareness and wisdom. So, we genuinely invite you, our listeners, to join the conversation. Let us hear your perspective on this.
Yeah, we'd love to know. Which financial habit of yours may be influenced by tech or just an old habit would you most like to change right now, and why? Maybe it's putting off saving because planning feels overwhelming. Maybe it's impulsive spending that gets triggered by social media algorithms. Or perhaps it's a lingering fear of investing because the markets, maybe amplified by AI trading, feel too complex or unpredictable.
By sharing your story, your experiences, even just your questions in the comments or our community forums, you contribute to this growing library of shared wisdom. It helps demystify these cognitive traps for everyone. Your learnings really do matter. Let's try to help each other build a healthier, more conscious relationship with our money, and also with these incredibly powerful technological tools we now increasingly rely on.
Thank you so much for joining us today for this deep dive into the psychology of certainty, risk, and the age of AI. Be kind to yourself as you navigate it all, and please, be wise with your tools.
We'll talk again very soon.